Hey everyone, this episode is brought to you by Avalanche. Everyone's favorite red coin is a fan of On the Margin, and we are a fan of Avalanche as well. Talked about it on the program before. Avalanche is a very cool solution. Their subnets allow for a very scalable blockchain that's also interoperable at the same time. And it's not just me. The institutions are noticing and they're building on the evergreen subnets as well. You're going to be hearing all about some of those institutions later in the episode. For now, Avalanche, thanks for making this possible.
Alrighty, welcome back to another episode of On the Margin, Roundup edition. We got the guys back together after a week off of debauchery for various national holidays in North America here. Mike's out in Brussels right now at ETHCC, so we just got us three going on here. What's going on, guys? Miss chatting to you.
Hey, Felix. Feels like we needed that week off, and good to be back.
Yeah, not really that refreshed, but I'm ready to go.
At least we got a lot to talk about this time. And, it's a pretty quiet week last week, but definitely no shortage of that right now. I want to set the stage with, we're recording this on Thursday because, as we're saying off camera, I got to go do some cowboy country stuff at the Calgary Stampede this weekend. So I'm jetting off early. We got CPI. Today, it really feels like, last month we got that soft CPI print, and some people are calling it, potentially a noise, a deviation, an anomaly, but we got an even colder CPI print today, and I think that really hit the nail on the head. So just going through the numbers. Core inflation year over year came in 3.3%, forecasted 3.4%. Year over year inflation headline, 3%, forecast 3.1%. Core inflation month over month, 0.1%. And the big one for me, headline inflation month over month, we have the first deflation since 2020. So we got negative 0.1% when it was forecasted for 0.1%. So I think, by all accounts, nobody's really denying that this was an extremely soft CPI print. I'm just going to share my screen and go through a few charts here, and then we can unpack and get everybody's take on it. So Ben Creek, who's really fantastic at this inflation data, Jack Farley interviewed him about a month ago, and that's how I kind of got onto his data. But this is a really great chart for just showing where is the change in the weighted impact from each month of inflation. So looking at last month to this month, the big reason why we got that deflationary print in the headline number was gasoline. So that gave basically like 15 basis points to the downside. And I think that was the big impact of deflation. So you could look at that and say, okay, great. This is just, energy and oil and gasoline super volatile. That just came in and brought everything lower. But the big story, and it's something I've been talking about pretty relentlessly on the show for a while now, is core services, shelter, and everything going on there. If you can figure out what's going on in shelter, you can figure out inflation. So the big news for me is looking at core services and shelter is that in June we got 0.1 basically increase in inflation versus the last month of being at 0.239. So a very significant disinflation in shelter, and that's really great news. Digging deeper, this is kind of the money chart for me, basically just showing shelter, and it just really fell off a cliff this month. So this is something that people have been looking at and hoping and waiting for this to happen to really truly believe that we're, getting very close to the end of the fight in inflation. And we went from, the previous month of shelter being at 0.4 down to 0.17, and a huge decrease in owner's equivalent rent, which is the big lagging one, from 0.319 to 0.204. So by all accounts, we have this true disinflation in the largest basket of the CPI. And again, this is from Ben Creek. He put out a blog post earlier this morning and just basically walked through what would happen if owner's equivalent rent and shelter just stayed at that same print for the rest of the year. So I'll just read this out. The answer is that in this no change scenario, owner's equivalent rent inflation drops to 4.2% and rent inflation drops to 3.5%. If this happened, it would push overall CPI down to 2.5% by the end of this year. If we continue to run rate this no change scenario through June 2025, it brings headline CPI down to just 2.3%. So again, that's even if we just stay, if we don't even get more disinflation in owner's equivalent rent, if we just stay at the same level, annualized, like we're right back at that 2% target. So that's the biggest things I'm looking at is overall, it feels like, the disinflationistas have won the battle. A lot of that fear about this reacceleration this year has proven to be seasonal and transitory. And by all accounts, it feels like that's setting up for cuts to come. What do you guys think?
I mean, cuts are definitely coming. I think in September, they're pricing in like a 90 to 95% chance of a cut at this point, the Fed funds futures. So that's, it's portending. My take on inflation is this. I think this is the hardest part between, stuff you actually experience, like my auto insurance going up 40% this year and my home insurance going up, 10% this year. And you see this number and the market is saying disinflationary, but we all know that's not really what certain categories are saying. So let's leave that aside. A sports analogy. If you're playing a sport, let's say basketball, and you're complaining, oh, the refs, they're not calling fouls. Like that is the same as saying like, oh, the inflation's so bad. It's the same market narrative where you're not actually paying attention to the rules on the field, which is break-even inflation rates, housing. Like Felix, you nailed that one. Your CFA totally paid for all those housing calls. but like I'm looking at, so let's go to chart 14. And this is something that like we've been paying attention to, pretty, consistently on the show, which is if you look at forward break-evens 1 year out, this has been telling us the true story the entire time. It's at 1.16 and even going lower. And now if you go to the next chart, this is what the Fed and the referees are actually paying attention to. So the orange line is the break-evens for 1 year, and the white line is the 12-month nominal yield. And the spread between those two are the real yields. So if you notice, like financial conditions are actually pretty tight. If you go to the ratio on the bottom, it was, really tight in 2008 and that caused a crash. Then in 2018, they over tightened and then they reversed quickly. And now we've been pretty consistently tight and you're getting a real yield relative to CPI. This is the rules on the field. It's not the real inflation that we all feel from our own lives, which is clearly, I think it's different, but it's what the market, goes off of. So those are the rules of the game. Anyway, long story short is we're now seeing the forward inflations of what the market's pricing dipping here. And there's no doubt about it. And Fed fund futures are saying in September, we're going to get a hike. So this could be an easing path. If this keeps continuing down, people are still going to get caught off guard here. I think that's the main thing. And if you're a pension allocator or a bond investor, this is your dream. You're hoovering bonds here. You're going to love bonds when inflation.
Just look at treasury auctions this week. Like they're just stellar. People are buying them hand over fist with good reason. Yeah.
And so, you get the data and the rules on the field, you're going to buy if you see those, forward inflation numbers come down. This is the volatility of the TLT, which is the 20-year ETF on 20-year treasuries, falling again and actually like making new lows. So as volatility drops in the bond market, global liquidity, global collateral grows. So the liquidity cycle feels like it's actually in the next stage here. Then the next chart, you go to high yield CDS, which is basically your protection you buy on high yields. Essentially, it gauges like spreads on high yield bonds. That's at lows. If you go to the next chart, this is European investment grade, which we saw a big pop in CDS and European investment grade bonds on the France election, and now it's receded back lower. And then if you go to the next one, even Japan's bonds, the CDS Japanese bonds are at lows. So global liquidity will get better here as global collateral, and inflation comes down. And so that's sort of what I'm seeing. And what the interesting part is we're seeing tech sell off on that because the centralization bubble, I think, is bursting before our eyes. But we'll see if, more time to come. So I'll stop there and let Quinn pontificate.
going into today, we had 75% chance of a September rate cut, likely 25 basis points. And after today, the odds shot up, to basically 100 for September, and then even brought forward above 50% chance in November and December as well, and brought more than 25 basis points on the table. So I think the response is quite clear. A couple of things I'm thinking about going forward is how this, is this faded or is this kind of pressed in terms of this new trend? And to me, base effects actually get better for inflation in August and September, the next two prints. So that bodes well for the disinflationary trend. The funny thing, even looking beyond that, is this move is actually what is going to kick off the beginning of the next, call it inflation wave or whatever it pans out to be. But it's this weak dollar that's been or the strong dollar that's been holding back a lot of parts of the economy and the markets. And we're seeing that today, where once that release valve, we've been talking about it a fair amount, kind of gets punctured, and we've seen this huge move in the dollar thanks to rates and the Fed easing, it kicks off this reflexive effect where now all of a sudden global central banks can ease. Now all of a sudden small caps, home builders, energy names are kind of propelled. And that's the real economy. So over the last 6 months, really the first half of this year, a lot of market participants and observers sort of got, lulled to sleep by this idea that NVIDIA and Mag 7 and QQQ is the stock market or is the economy. And I think that delineation in this kind of two-speed world is going to be really important going forward, and what this reversal means. Stocks can continue to go up, and this is the first sign of that healthy broadening out. So will be interesting to see how it develops and what moves stick and what moves are faded.
The broadening out is pretty wild. If we just look at like this performance from today, so obviously this is Thursday, and we're just seeing this huge rotation happening that we're talking about here. So obviously the trade has been large cap growth, NVIDIA, Apple, Microsoft, et cetera. And just like as soon as, I think ES futures right after the CPI print were up a lot, and then the whole thing just reversed. And we've just been seeing this continuous rotation. And the top performer today is just the small cap value. And at the same time, we're seeing just, implied correlations is something we've been talking a lot about and trying to figure out, like, where does this go? How does that affect this dispersion trade? How does that affect, we've seen a super narrow rally in markets. Does that broaden out like you're saying now, Quinn? And it really feels like, something just, the switch got flipped today, it seems like.
Hey everyone, this episode is brought to you by Avalanche. Avalanche is a leading network of blockchain, which is giving access to some of the world's largest financial institutions to experiment and build on crypto rails. I'm a big fan of Avalanche. I've talked about it on this program before. The Subnet architecture leverages some of the best parts of IBC over in Cosmos, the interoperability protocol, and the rollups on Ethereum, with the result that if you're a financial institution, you can build on something that's highly interoperable, but also customizable and scalable. And it's not just me. Many of the largest institutions in the world are taking notice. And a couple examples of folks who are building on evergreen subnets include Onyx by JP Morgan's. They leveraged an evergreen subnet to explore how tokenization can revolutionize the asset and wealth management industry. Citi and the DTCC digital assets are testing private market tokenization on the Avalanche Spruce testnet with Wellington and Wisdom Tree. So again, some of the largest financial institutions in the entire world are building on Avalanche. Avalanche Evergreen provides a suite of institutional blockchain deployments, customizations, and tooling designed to address company-specific and industry-wide requirements for financial services. So join the institutional investors that are choosing Avalanche today. Go to avax.network/evergreen. Again, that's avax.network/evergreen and join the revolution. Avalanche, thanks very much for making this episode possible.
To add to that, check out slide 17. It's the Goldman Sachs momentum basket. And, that big spike when I called the blow off top a couple of weeks ago, not to plug myself, but like it was when implied correlation was diving and everyone is piling into the momentum factor. It's breaking the 50-day here. And if a weak dollar really is more conducive to more decentralized world, and that could have been the top of the momentum bubble and the top of like quant investing and all this other stuff. And that's yet to be seen, but like we'll probably be able to call that 6 months from now. But there's definitely signs that, a lot of this stuff might unwind and get more evenly distributed. And the guys that had, large cap tech had immense cost of capital advantage in a weak dollar environment that just doesn't exist anymore in Fed easing. So we'll see if that rotation keeps happening.
Yeah, I'm curious what you guys think. It feels like, I don't know, to me, it feels like a lot of what we've been talking over the last couple of months hit a crescendo today. And it's sort of like, okay, what's next? Like, we have a pretty good idea that inflation is, for the most part, done, at least for a while. Like, we're very, very close to target. We've had this blow off in tech at the same time of that, and then this huge catalyst of rotation. So for me, I'm trying to figure out, okay, what's next, right? Like Quinn, you had mentioned about how this could potentially sow the seeds for further like reacceleration of inflation next year. But what do you guys think?
Yeah, I'm in the economy is fine until proven otherwise camp. I think that the left curve premise of you can't have a real GDP recession when fiscal deficit spending is at 6 to 7%. And to me, things got so stretched in this other direction on growth scares. Like if you look back to the last 3 to 4 months, it really started in March. It's been this pretty choppy, uncertain environment that I would characterize as not all that great for markets and the economy outside of NVIDIA and AI and Mag 7. And to me, those assets have become the flight to safety in a world where sovereign bonds don't hold value anymore. US Treasuries have been the worst performing asset class for almost 4 years running now. And in times of global uncertainty, people would flock to the dollar. So we saw the dollar remain strong. But instead of flocking to US Treasury bonds, people were flocking to the secular AI growth trend. And so I think moving forward, to me, I would fade any of the growth scares moving forward, because as we get closer in proximity to rate cuts, it means an even further bolstering of the economy via monetary policy that we haven't had for multiple years now, in addition to this ongoing, massive fiscal deficit spending. And so that's why I think you're seeing the home builders and the cyclicals and the energy rallying hard today. And I just wouldn't fade that trend. It's this broadening out, and to me, growth's going to pick up. Today could have been a capitulation move in bonds, the other way, I guess, the bottom, let's say, in yields, and a top in bonds. And I would look personally to re-inflecting of US growth. It probably ultimately means another episode of this, 6 months from now, right? Where the dollar gets strong again because the US economy is outperforming again. And we have this similar type. Definitely a preview.
Definitely contrary to that, though. I feel like Trump is going to initiate a US dollar policy that's weak. Like he doesn't want a strong dollar. So that's the only contra I'll say to that. I agree, though. You could have those, stronger economy, broadening economy at least.
Yeah. To me, the issue of strong or weak dollar is less predicated. I mean, ultimately, if the president makes these decisions, it is presidential. But to me, it's more based on how the deficits get financed, right? So like we're spending hand over fist, which is why our economy is much stronger. And we've had all these liquidity facilities that have basically not required additional monetization of the debt like other countries. The RRP, the finagling of the treasury issuance. And so as that stuff abates and going into next year, then you probably have to see the Fed reinstigating QE and things like that to finance these deficits. But right now they've gotten away scotch-free. And I just don't think that right now is the end of the AI bubble. Like there's still, the markets, I just would position more for a cooling off of the AI Mag 7 trade and pure leadership, and more into broadening out. Those things just stall instead of going vertical. And it's not those crashing. It's just everything else kind of catching up.
I agree there. Check out, I was just looking at the PEs of Apple. Apple's Ford PE is 34. Microsoft's 38. I mean, NVIDIA is 47 in 2025. So I think we're just overcooked on that side. And if you have one bad earnings print for some of these large cap techs, that rotation is just going to keep happening.
Yeah. The PE thing has, I think, probably caused the most amount of either bear sidelining or something for a long time now. And I saw this interesting take from Warren Boesler, who's been getting a lot of press recently. He did like an interview on Bloomberg recently. He's kind of the father of modern monetary theory, but even he's pushing back at the current situation of the government spending like a drunken sailor. But he put out a tweet that basically just said, stocks have an inflation hedge / tail risk type of component independent of government indexes like the CPI. The elevated PE ratio is a market pricing this option premium. And that was just such a cool take. Like I've never heard it put that way. But, you see these people get really frustrated that, earnings are just, earnings expectations are just through the roof. And we need to be seeing this reversal back down. There's no way they're going to continue at that height. But again, like the last couple of years, there has been a fundamental story to the tech rally. Like PE's, earnings, the earnings side of it has gone up a lot. Like looking at just the trailing 12 months PE of NVIDIA, it's actually, if depending on the right way you look at it, like it's actually gone down in a lot of ways, which is really funny. So, if we continue into this world of further, currency debasement, high fiscal deficits, the exhaust valve for that, I feel like, is the PE ratio, the multiple expansion, and that can take us higher. So I don't see the full ends of story for equities just because earnings expectations are stretched.
Yeah, and the other thing is people are going to continue to hide out in equities until something better appears. I think eventually that better will be commodities, energy, precious metals, but you got to be dancing when the music's playing, right? Look at 2020 to 2021. PE multiples remained elevated for many, many months. And if you hold out saying things are too expensive, I'm right, the market's wrong, eventually it'll come around to me. You'll be on the wrong side for a long time. So it's this kind of fine line you have to dance.
To that point, there's something interesting that I've been thinking about. Like if you check out the Nikkei, it's literally making new highs. And this is just, I think in general, we're probably heading into this type of world, which is a rotation out of bonds, which will soon be called, certificates of confiscation if they don't count volatility on the bond market. It's really crazy. Oh, wow. Yeah. And like people they're naturally like delevering their economy with nominal growth. And that's probably what's going to happen here too, eventually. I think that's why a weak dollar policy makes a lot of sense is you have to grow your way out of the debt. Debt to GDP is what, 125%. So that will have to happen, and it will have to be more broad-based than just like 7 stocks. And I think that, the vol controllers will make that happen no matter what over the long term. Policymakers, if you want to live in a society, will have to do that. And I think we're seeing the beginning of that, is my point, where weak dollar, Fed easing, rates coming down, and now it's only to get juiced from there with if Trump actually gets in.
The calculus that you keep bringing up is really difficult. Is that like I've been so focused on where do we get for the year into 2024, because 2025 is just such a minefield of potential outcomes, like things of like Trump policies of he's talked about devaluing the dollar. If we get a Republican sweep, that can just lead to just them ripping bills through, tax cuts, et cetera. How does that affect the long end of the bond market? I feel like the bond market's trying to figure that out, and I don't think it's fully figured that out yet. So, and the same thing too about like monetary policy. Like, there's been some, speculation of what he does to Jerome Powell and just the monetary, like the Fed, complex of, more power going to the fiscal side for setting monetary rates and that sort of thing. So it's super hard to know what happens in a year's time right now. I agree.
And there's a lot of like political things that are really hard to discount. But say you have a peace premium and Trump gets Russia out of Ukraine. One of the big pieces that Biden, I think, kind of screwed up was taking Russian assets, because that stopped a lot of the petrodollar recycling into US dollar assets. And if there's like a detente in that global capital liquidity cycle, we could see more money come piling back in here. And then the game is just economic Cold War. It's not kinetic war anymore. And, I just think that's an interesting perspective to look at from the political side.
Before we show, I want to spend some time to talk a bit about what's been going on in crypto, because I just feel like we're all just talking about how constructive we are macro side of things, but then Bitcoin's just getting absolutely decimated by German government right now. But before we do, we talked a lot about inflation, but I also want to spend a little bit of time looking through some research that I've been digging into around the labor market and this whole idea of immigration causing increased labor supply, that causing an artificial unemployment rate that's going higher, because that's been a lot of talk right now. And that paired with what we're seeing with CPI is having a lot of people try to figure out whether we're on the verge of a recession or not. So starting with just level setting, there has been way above trend immigration into the US in recent years. So, the last, like in 2022, there's 2.5 million, and 2023, 1.5 million. We're way above trend. That's a fact. But what's really interesting is, trying to figure out how does this increase in immigration and basically in labor supply actually affect the economy. And there's some really interesting research that came from the Dallas Fed this week. This came out a few days ago, looking at what are the effects on the economy of an immigration shock versus a natural labor supply shock. And there's a few interesting components here. So looking at real wages tend to increase as labor supply shocks occur. But when you look at immigration shocks, this is actually counterintuitively, or not really counterintuitively, but it drives real wages down overall. And we've been seeing this happen over the last couple of years. Real wages have been coming down. That's giving a lot more confidence to the Fed that that wage price spiral is not occurring. But what's also interesting is we typically see this minor blip in inflation caused by this, basically more people flooding into the country, leading to more people chasing the same amount of goods, leading to an increase in inflation. But the research has shown that this hasn't actually really been the case. There's been just the most minor of bumps in inflation. Next chart is looking at what does this population surge do to GDP? And again, it leads to this outsized GDP growth, but at the same time, that might not lead to the same increase in per capita GDP. So the big takeaways I got from this research is that it leads to higher GDP. It typically leads to a bump in inflation. And I think that's really interesting that we've been seeing these weird seasonal blips of higher inflation that have been taking the Fed off guard, especially in like the first half of this year. Tying that all together to some really interesting research that an economist on Twitter called Parker Ross, who I want to chat with soon. He's been doing some really, really good research, digging into trying to pull apart, the unemployment rate and what's actually driving it. So the big discussion happening right now is we're seeing the unemployment rate increase. It hit 4.1% just a week ago, which is already above the Fed's year-end target. So people are trying to figure out, is that going up because there's more people immigrating into the US that don't have a job, or is it people with jobs already that are losing their jobs? And so he actually dug into the specific granular detail and uncovered that the vast majority of the increase in unemployment rate is indeed actually just Native Americans losing their jobs. There's a small increase. So, the gray bar looking at basically foreign. So there's a bit of a blip for sure, but the vast majority of the increase in the unemployment rate has been from people actually losing their jobs that live and are from the US. So there's been a lot of this discussion that, the labor market's super tight still. The increase in unemployment rate should be faded because it's being driven by immigration. But I think what's really important to see is underneath the surface, this is actually, I would say the labor market is potentially looser than many expect because of that. Weird counterintuitive thing where people are thinking that it's just immigration. So I just want to put that out there that it's that paired with what we're seeing with CPI right now is really setting the case for, I think if the Fed wasn't so obsessed with forward guidance and that sort of thing, we'd be getting a July cut, but we got to let them play their dance, do their game, and kind of just wait it out. So I think like the September cut is baked in. I think we're definitely going to be way above their last June SEP of only one cut. Like I think 3 cuts is totally realistic by year end. But again, then becomes what happens in 2025, and that's a big question. Just want to put that out there. I don't know if you guys had any surprising takeaways from all of that, but I'm curious to hear.
Yeah, Felix, just when we were talking offline was about the government crowding out and what the actual ramifications of fiscal deficit spending, like we're seeing in the US. We have established that a big chunk of the month-over-month job gains are from government employment and then kind of ancillary government funded being healthcare and education. And maybe this is a deeper topic where we can dive in a later show, but people ask, what are the costs of inflation and how does this government spending impact the long run? And I think we're seeing it in this hollowing out of the private sector as the government kind of crowds out funding. And we're seeing that, right? The government is financing itself with these massive deficits that are unsustainable. Meanwhile, the cost of capital is rising because of that. And small businesses are getting hurt. Small caps are negatively affected. The lowest income consumers, have a lot less disposable income. So I think that's an interesting longer term thing we can dive into maybe next time. I'll prepare some thoughts.
I just got to give props to Felix again for dropping the Psalm rule before everyone else, because to
be fair, everyone else except for my boy David Cervantes, who has talked about it before me. But aside from that, definitely was front running the everybody starting to yell about that pretty soon.
Yeah, and that goes back to the rules on the game. Like what we're trying to do here is figure out like what are the policymakers really react to, and instead of just like intuiting your own inputs on those things. And I think you kind of nailed that one. So props to you.
Thanks,
level 1 pass.
Man, I think like that's such a good point though about, I sometimes when I put out a take about, I don't know, CPI or something like that, people are like, oh my God, I can't believe you think this data is real. Like, how could you believe this stuff? And it's like, I don't necessarily believe it, but I know the people in power believe it and they will react to it and they will have decisions based on it. So therefore I have to believe it. And it's this big, stupid game theory we play in finance where there's all these data points that come in. And again, like all this stuff gets revised anyway a year down the road, but it moves price. So therefore we have to pay attention.
In their defense, it's the best model they have. And if you look at China, there's something definitely going on in China. In terms of slowing the global economy. Mike Howell just put out a piece this morning that said China's been slowing. It's why the global liquidity cycle took a blip essentially in the past couple of months. And if they turn on with a weak dollar, I was just checking out EEM today. Like that thing's look like it's been basing for, I don't know, let's see.
That's like the emerging market ETF, right?
Yeah. And a lot of it's China, but a lot of it's not. And it looks like a 2-year base. It almost looks similar to IWM and a lot of like XBI, a biotech ETF, basically anything that benefits from like a weak dollar. ARKK looks similar. So anything that's like emerging market or futuristic tech that's not quite mature might benefit here.
Yeah, in the crypto section, a good chart on slide 23 to lead us in. We're talking about this broadening out, lower cost of capital for the periphery industries and other parts of the economy outside of big tech. And crypto is one of those actually. So, lower bond yields, weaker dollar, all coincide with what we're seeing play out. And that benefits small caps. But interestingly enough, this is a chart. Blue line is Russell small cap index over the SPY, S&P 500. And basically in 7 of the 8 last multiple week bouts of outperformance for the small caps. It's also coincided with crypto strength. And the example where that did not hold true, the 1 out of 8 was the May to November 22 period when we had, Celsius, FTX, all the big bankruptcies, BlockFi, Three Arrows. So it's a pretty, people kind of question like why this exists. And it all has to do with that cost of capital liquidity. As Tyler mentioned, things like the MOVE index of bond volatility coming down, inflation volatility coming down, oil prices they don't have to be down, but just not going, super high, the dollar being steady. And you're seeing then giving the green light to other global central banks too. So I think, crypto's obviously been trading very, very heavy. These supply overhangs are not to be underestimated.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back Permissionless. We're going to be doing Permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for a DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there.
Yeah. Can you just take a step back and kind of walk through, like, I don't know, Qs have just been going up only for a while, and Bitcoin has just been bleeding lower. Can you just give a bit of a summary on what's been going on there with the German and Mt. Gox situation and all of that?
I kind of spent a lot of time looking at this in late June or in the last few weeks, because when I started to get constructive from my macro perspective was late June. And I should have just longed Tesla instead of wasting my time on crypto. Because, similar.
You did tell me, check out Tesla here like a couple of weeks ago. But I'm seeing what you're seeing. It's just, you gotta let you finish.
Yeah, the macro was starting to show signs of reprieve. You have other liquidity improvements coming on a quarter-over-quarter basis. Q2 was a blip here for a number of reasons. That was a big drain. And so from the macro side, getting constructive in late June, and then we obviously got hit with the Gox and German US government selling events. So I think a good takeaway from that stuff is, the markets were still trading heavy, going into those announcements. And there's clearly a reason, people are kind of front running, and the market, it means, is not overall that as strong as, you might think it would be given the macro. There are elements of it though that feel like a beach ball underwater a little bit though. The classic events that cause capitulation bottoms are, for sellers. And it appears, given the execution, that's what we're seeing in some of these cases. So I think, overall, we've had this huge supply overhang that's been plaguing the industry for actually a number of years. And this is probably how bottoms start to form, where you start to progress through these events. We're now down in the Germans' case to basically 1 to 2 days of Bitcoin ETF inflows remaining. And, you can climb that wall of worry further and look forward to this macro environment. So ETH ETF likely next week. I think there's a number of things, but clearly people have been stung hard, good enough that the animal spirits and appetite to relever are slow to come back. So we'll see how it plays out.
Sentiment check. I got to ask this question. It's been bothering me so much. All right. So say I'm a large holder of a stock, right? And for some reason, I have another liability that I have to pay, and I have to get out of that stock. As a trader, say I own 10 million shares of Microsoft. I call up, the head of the desk at Morgan Stanley, the head of the desk at JP Morgan, and I say, hey, go call Fidelity, go call Wellington, go call T. Rowe, and I need, see if they can put a block together, clean me out of this supply. Why? It feels very politically driven to me of why Germany is just, hammering and then
smashing it. Yeah.
It is the dumbest execution. Maybe it's just a bureaucratic, fumble, but you could get a way better price if you just figure out, put together a block trade, right? And that, I don't know if there's anybody doing that in crypto. If we have any viewers that have, could just send me a DM, because if this is market structure where you send it to a different exchange and then pound the hell out of it, and it just makes zero sense. Like maybe it's so quantitatively driven, and you're doing it on July 4th. Like, to me, that's
insane
that it's political, but maybe I'm wrong and they're just that dumb.
Yeah. I know they hired Cumberland, which is a market maker, for some part of that execution, but I don't know specifically how much or when or how they're executing it through what exchanges. But I think you're right. But also, people have been giving shit to Michael Saylor on his execution for years, because he just people just, when they look at the flows, it looks like he just logs on to Coinbase on his phone and just smashes market buy a bunch of times. Like, I think it's just, Tyler, unfortunately, it's just like the industry is just like not that sophisticated, I think. Yeah. And I don't know, maybe we should get somebody like, I know Jonah from 1000X podcast. He used to work at Cumberland. He knows a lot about crypto market making, but I don't know. Have you heard anything, Quinn?
I don't know. I'm guessing it's just classic, like it's a pure example of like how governments operate, right?
But I mean, here's the other thing. No one understands market structure. And so I'll say this again, because I don't think people really understand what I'm saying. But back in the day when you interact with counterparties, you could be like 30, 40% of a trading volume. And I would be trading against Quinn because there were two people that were like, well, I like this price, I like this price. And you could be 40%, 50% of the volume. You could cross stock. Now, because all these dope MIT kids created all these algorithms, they're winning. I'm just, a little bit salty, but it also creates these, creates opportunities. But now you can be only like 4 to 5% of the daily trading volume in a stock and not affect it, which basically means there's not real buyers and sellers in the market. It's all high frequency. So if you take out high frequency, which is like 60% of trading volume, if you are a real fund, you are now way more of the trading volume than you think you are, if that makes sense. And that's probably the same in crypto, where like you have Jane Street and all these clowns muddling markets, and the real demand is not actually being seen. It used to just be like, a new buyer is in.
Totally.
And then seller. So the markets are so much less opaque than they used to be, which is why morons like Germany will come in here and smash it and not understand liquidity or market structure. So, and I don't know crypto market structure as well as I know,
Yeah. I mean, well, I think just to shine a light on that a bit, I remember, I don't know if you guys do, but like when FTX imploded, basically the 4 months after that, a lot of market makers pulled back from activity in markets. And suddenly you could just see like the spreads just get super messy. We went through this like terrible pattern where we would just randomly like the chart would surge for a minute and then it would just sit there 15 minutes and then just BART right back down to where it was. It was super inefficient. And it was super crazy to watch for like 4 to 5 months as these market makers pulled back. So totally, like, I think it's just, I don't know, not as like...
It's a side effect of like 24-hour markets, right? So there is benefits to a 9 to 5 market in that sense, because liquidity is concentrated and it reduces volatility. Because if you can trade, I mean, it's just like trading in the pre-market versus trading on the open and close versus trading at noon. If you try to move the same size at all 4 different periods, you're going to get tremendously different results. And then, try that spread across, every time zone and holiday and what have you. So I think it's a feature and a bug of the space. And it's just something you have to factor into your process and your outlook as to, have this other angle of analysis and incorporated.
Me and my buddies at Franklin Templeton, we would say last price is a liar. Price is an equilibrium of liquidity. So like you'd see like the stock trading back and forth, but like to really get a gauge on where the demand is, you have to actually make calls. Like that's the funniest thing. So we've come full circle where HFT has perverted markets so much, you're actually block trading again.
I think it's like, I mean, that's why I love still, even though I love macro, like I'll always be a DJ in crypto traders because I find there's so many inefficiencies and just edge in that world, because either like, last cycle I was pretty deep into like flipping NFTs and that whole thing. And that just taught me a lot of lessons about like finding liquidity, finding real price and demand, but also just seeing like how reflexive these things are. And like, sometimes even like a news could hit on whatever project and you could just get in front of that, like if you're quick to it. And Blur, which is like the NFT exchange, kind of ruined a lot of that because they made that more efficient. But back in the glory days of like OpenSea, like it was just hilarious, the inefficiencies you could find.
I mean, look at the April, what was it, 17th or 22nd or whatever, kind of Israel-Gaza situation, right? That Saturday night is when it happened. You had an extreme nuke in crypto that was basically recovered by Monday, and stocks closed Friday, came into work Monday and was like, nothing happened. And crypto had this like crazy path. So there are benefits in some respects, or at least it's volatility reducing to have a 9 to 5 concentrated liquidity versus 24/7.
Yeah. I want to ask you guys a hypothetical question, because earlier in the show, we're talking about this potential for the big tech QQQ, trade to have peaked out recently. And a lot of like correlation to crypto is based on crypto to that big tech and to Qs. Like, if that is unwinding, do we still, like, my base case has been, okay, we're going to see the glory of all catch-up trades soon in crypto once these supply issues basically finish and Germans have no more coins to sell. But if that happens at a time where, say, the Qs are pulling back, do you guys think we could still see some idiosyncratic catch-up in crypto, or do you think it's just too tied to the hip of that?
Gold looks like it's going to break out to new all-time highs and keep going. I don't know. I think this next stage of Bitcoin, if it's really a store of value, it should follow gold in a real supply glut in a weak dollar environment. It should play catch up, but it has some work to do after this. Germany.
This period reminds me of 2021 late summer quite a bit, actually, where you had this huge negative crypto event. At the time was the China mining ban, and markets just kind of kept drifting lower until late July. It was at that time when it just all of a sudden caught up in like 2 months, basically a month and a half through August and early September. And then that kind of led into the final rally in October, November. I mean, eventually these correlations, Bitcoin's not going to just keep going down only versus gold and NASDAQ. So in the same way that it's decoupled to the downside over the last month, 4 to 6 weeks, I think it certainly can be uncorrelated to the upside as well. The gold data point is super helpful from a macro flows perspective. Like if gold keeps ripping, human nature is, eventually to go out the speculative edge into gold miners and digital gold.
Yeah. I just threw this chart together, but just tying back to what Tyler talked about at the beginning of the show, just looking at real rates, which is the white chart, like this has been one of the biggest drivers of gold price action, and they're largely inversely correlated. So when real rates go down, generally the gold price goes up. Like it has gone through phases of following that correlation. So what we've been talking about at the start of the show is talking about how real rates have been increasing because inflation is going down, while rates have been staying flat. So that creates higher real rates. So the Fed needs to cut rates to get to even the same level of real rates because inflation has been coming down. So if that brings real rates lower, even if the Qs aren't doing as well, I do see a potential outcome where Bitcoin could follow gold, which looks like it's finally... gold has been pretty crazy because there's been this like 3-year span where real rates have been like cyclically very high, but gold has been doing well still because of these unique geopolitical risks and like fiscal risks as well. So now we're seeing the next potential leg higher from these real rates coming down. So yeah, I mean, maybe you guys are right, and we might see that happen as Bitcoin follows too.
It's a really interesting thought experiment to piggyback on that. Is if gold is outperforming and gold is mostly actively managed, I don't know of many like passive gold funds out there like GDX and GLD, but the wave of capital that will underperform in Qs and all these other places where capital has concentrated, like, will that swing the passive pendulum back to active again is what I'm asking, or will passive just undercut and piggyback on, the active managers again and push all their prices up? It's kind of an interesting thought experiment. But I'm more worried about the retirees that got, if this is the demographic turning point that Mike Green talks about, where everyone's piled into the queues and now money slowly comes out as the retirement funds sell. Like, will this phenomenon get worse? Today we're seeing, the queues are down 2.5 and IWM's up 3.5. Like, that's a 5% move delta in like one day. It's like kind of telling something's funky is going on here.
maybe the next iteration, it's, everything is this bundling and unbundling. And you can think of ETFs as bundling the stock market, right? And what we're seeing now is still ETF usage, but sector ETFs and thematic ETFs, right? So what started as just the SPY has now gone to the XLE, the energy, and the the semiconductors and the home builders. Your next big move in like passive is like active passive, where you have these like rotational ETFs that just basically put on these trades of like, we're going to be in Qs, then we're going to be in small caps, then we're going to be in energy, then we're going to be in healthcare. And you still don't have the individual stock picking, but you have the sector and thematic picking, which is interesting. Yeah. Like I don't know if that happens, but it feels like it very well could.
I agree. And it's also scary because like due diligence goes out the window, and then you get a misallocation of capital. All these fraudsters that are like, "Oh, let's start a SPAC."
Well, right. It's like that's like it's passive to the too far degree, right? Where we just started passive as like this broad exposure, and then we like wanted to apply passive principles to an active style, or active principles to a passive style, but you're not doing any due diligence, so. You're still not basing anything on value, fundamentals, earnings growth, cash flows. It's just momentum.
Because everything's so passively managed, you could have all this research done and say, this stock is a fraud and it won't go down because Vanguard, BlackRock, and State Street hold it. And it's kind of crazy to think about that we're now at this point, and there's no short sellers left. They're the only short sellers left. There's a handful of them. But like a lot of them just won't do it because there's a tide that's working against you. And here's another thought. Like when I started in the biz in 2007, they had so many more people working at these companies. And then as technology grew and grew and they annihilated a lot of stuff, it became commoditized. You really just left due diligence in the morality of picking a stock because of like, it's a good thing for society. That just went out the door. And I like to think at some point that comes back, but maybe a lot of people have to lose money in passive for that to actually happen.
I mean, I think also like just getting away from this regime of ZERP is also going to be helpful for that, because when that occurred, everybody had to pile into equities to just find any sort of return. So I don't know. I feel like even though rates are probably going to go down a little bit now over the next while, like it is a healthier world when there's a price of money. Without it, like we get all this crazy noise and these weird misallocations of capital. So hopefully that helps it too. I don't know.
Definitely true. The problem is that they're still tampering with the cost of money via the long end, which is actually the most impactful, much more than what all the commentators are talking about is going to happen with the Fed funds rate. And I think that's to me the point of that gold chart and real rates is why it has disconnected so much, is because yes, gold has decoupled, let's say, where real rates were rising and gold was moving higher still, but it was because the governments, Treasury and Fed were putting and still are putting a ceiling on the cost of long-term sovereign capital. Actually, interesting thing I saw on that side is I think his last name's Flood, the guy who runs the Treasury debt issuance program, is testifying, I think, to Congress. Yeah. So there was a Bloomberg article, I believe it was Bloomberg or Reuters, kind of talking where he'll get grilled on if they're manipulating, debt issuance and all this. So that actually, I didn't see too many other headlines on it, but it actually should be a pretty interesting discussion.
I saw it too. That'll be interesting in the lead up because we're going to start talking about TBAC and QRAs again at the end of this month, I think. So that'll be an interesting one to hear before.
And going into Jackson Hole, where you have these Treasury policies where they're directly colliding with Fed policy and a lot of potential, future balance sheet changes.
Can't wait for the, soup of all these acronyms. TBAC, RRP, it's QE. It's ball controlling.
That's right. It's so
fascinating.
Yeah, it's all yield curve control.
It's the best term I've ever heard. Like it just encapsulates it so well. Like instead of just this word salad of acronyms, it's what it is. Totally.
Yeah, you're just deciding where to allocate money in the big scheme of labor to capital. Centralized plan.
Centralized. Let's talk about. Somehow this wasn't actually my meme of the week, even though this happened right where I live. Tyler, this was your idea. Do you want to preamble this before I play it?
Yeah. Oh, you actually got the video.
I think so. We'll see if the sound works, but at least I have the video.
Okay, so I got a lot of heat for this. And I'm rather apolitical. I like to give equal opportunity shit, but it's just been so easy. Like when my buddies in comedy are like, it's just so easy to pick on the left now. I thought they told me that about a year ago, and I got a lot of crap for it, for saying that the counterculture is actually conservative. Like young kids are actually becoming conservative. It's no longer that cool to be super liberal, and I think that's the funny thing is for 15 years, it was really cool to be liberal. That it was the cool thing. You were, and now it's changing. And so Mick Jagger is up on stage. You can play the video now.
Let's see.
We love your Mr. Trudeau, and his family has always been such big fans of our family.
So he says, "We love Trudeau."
They all start booing.
And everyone starts booing. And it's it's such a shock. This guy's been an icon for 50 years, and all his politics were coolest thing ever.
Yeah, it'd be a pretty safe bet to think that a country generally likes their leader, but yeah, he didn't check the polls where it's 67% of Canadians disapprove of Trudeau. So it's not a safe bet.
And now, not to get too political, but Clooney's dropping one on Biden, and now you're going to see all the celebrities. I think there's going to be a mass exodus, and that is me being I like to think of myself as a classical liberal type, where it just got a little crazy. So I'm not a pro-Trumper by any means, but it's more of I think it's an objective observation. Maybe I'm wrong, but I think it's a fascinating cultural point where you're holy crap, this guy led culture for 50 years and is just so off base there.
That video could go down in pivot lesson, objection handling. He's just switching, just ignores it. He's
to be honest.
Football.
Yeah. Yeah.
I'm going to pull that one up next time I say something that doesn't go over well. And how about the football team?
To be fair, we did just go to the semifinals, and we got beat by Messi, but we did pretty good. So he did. I'm glad he had that ready.
I hope Canada makes a comeback here. Can we get some pictures? We need Stampede pictures, by the way.
I'll do that.
Stampede selfies on Twitter.
Just need to find a good cowboy hat first, but it's gonna come. And yeah,
and with just shave the beard, just keep the mustache.
That would look unreal. Find maybe some aviators or something too.
Yeah, or just shave it and look like baby face Quinn over there.
Yeah.
Guys,
right,
no one knows. Quinn's 40 years old, but he just keeps it tight.
Tighter than our operation. Yeah. Shout out to the one guy on YouTube who keeps commenting that we should all shave. I think Quinn finally listened. So,
but now he goes to boardrooms and they laugh him out. This is 12-year-old.
You're more trustworthy if you're clean shaven.
Apparently.
Not that I'm very trustworthy. Probably the most trustworthy person here.
Well, now I don't trust you.
So, yeah. All right, guys. Well, I'm going to jet off to Calgary, to Cowtown, we call it. So
Enjoy.
Yeah. All right.
Have a good weekend.